Okay, so now turning to California, of course, one of the most important issues as we go into, actually, we are now in stay-at-home orders and other restrictions on business activities, what are known as non-pharmaceutical interventions, is how much is that going to affect the economy both today and going forward? So I've entitled this talk "To Close or Not to Close." The image you see here comes from the New York Times. It's from their December 4th paper. And there are three maps of the US, and they're colored from blue to a dark sort of ochre brown. And the darker the color, the more restrictive the NPIs or non-pharmaceutical interventions are. And those are business closures on the upper left, mask mandates in the middle or on the upper right, and stay-at-home curfews on the lower panel. And so we want to exploit that differentiation across the US to try and understand what's happening in California. And we're going to do that by first starting with employment. So this is our roadmap. And then going to the various sectors and what are their prospects. From that, looking at some evidence on what the lockdown is doing to California, both right now and as we move forward into the future, and then on to our forecast. So let's begin with employment. And the graph that you see here is non-farm payroll employment. It's the number of jobs. The dip in the middle is the Great Recession. And then as you see, as the economy closed up in March, late March, early April, we just fall off a cliff and get some return of employment in the last couple of quarters. That corresponds, of course, to what was happening in the US as we had an easing of NPIs. The dip didn't go all the way down to the depth of the Great Recession, but what's important here is, and these are October 2020 numbers, is as of October, we are still 1.5 million jobs below the February peak of over 17.5 million payroll jobs in California. So a long way still to go. Let's see where those jobs are located. This is non-farm payroll job loss by sector from October 2019, prior to the pandemic, to October 2020. And on the right-hand side, you can see the big two losers, which accounted for 55% of all unemployment in California, are leisure and hospitality. And that was certainly due to the closures. And education, and that's mostly public education, and related to the fact that children are not in school. And even though they are Zooming or using other platforms to connect with their teachers, you don't need any of the support staff at schools. But that's going to depend very crucially on the ability of government to fund schools as we move forward. And then the next four, which ends up accounting for, with those first two, 3/4 of all unemployed in California are healthcare and social services. And as Leo said, that includes daycare, administrative services, which includes services to buildings that people are not going to, offices, as well as temps, retail trade, other services. And so all of those are what we call human touch or human contact sectors, high human contact sectors. These are the ones that are differentially affected by this pandemic-induced recession and the fear of congregating in crowds and of infection. And so these are really going to be crucially dependent on when the pandemic ends, crucially dependent on the assumption that we made about vaccines. But that's where we're going to focus. So the first thing, let's look at leisure and hospitality and a couple of aspects of it. In California, as well as New York and Florida, international tourism is important. 3/4 of all international tourists come to one of those three states. We have about a third of that 3/4. And here's international tourism as represented by international passenger arrivals at California's two large airports, LAX and on the top and SFO on the bottom. And as you can see, it just collapsed. And we don't expect that to come back until after the pandemic is over with. Keep in mind that in 2018, California hosted 1.5 million visitors from China. They're not coming, and they're not going to come until they have some sense of their own safety coming to California or the United States as tourists. Another aspect, of course, is restaurants, and restaurants closed up in April and May. The chart that you see here is restaurant customers in 2020 as compared to 2019. It's the year-over-year percentage change. The data comes from OpenTable. And if you look on the left-hand side, what you see is April and May is near 100% decline, that restaurants were basically closed. And then as the California economy began to open up, the NPIs were eased. June, July, August, September, October, more and more folks went out to restaurants. But as infections started to increase and this current wave that we're in started coming back, even before the new shelter-in-place orders came out and closures came out, consumers stopped going to restaurants, and so you get this now decline. And the shaded area there in December is the first few days of December. So there is, an aversion to the risk, and people are paying attention to the data. So leisure and hospitality, we expect to come back slowly and not really to make much of a dent in that unemployment until we get past the pandemic. Now, what about that second item, schools, which depends on government finance? Well, this is a most unusual recession in that regard. The graph that you see here is California cumulative general fund revenues. So this is tax collections by the state. The blue line there is fiscal year 2018, 2019. It starts in July, it goes through June. And of course it increases through the year because it's cumulative with a big jump in April. The red line is 2019 through 2020, and it is above the blue line. And that's where the pandemic starts, where I put that triangle. And it kind of flattens out at the end. But what is really interesting here is the pandemic, of course, continues all the way to the latest data, which is October. But the current fiscal year, starting this July, we have tax revenues that exceed those in the non-pandemic year, early in the year of 2019, 2020. So why is that? The answer is that the tech sectors, real estate, which we're going to turn to in a minute, and the stock market all have been doing well through this recession. And those generate capital gains. And that's a big part of the funding for state government. As well, sales tax revenues are only slightly down. And that's because of the shift that Leo showed you from services, much of which are not taxed, into goods that are taxed in California's sales tax system. So the state is doing relatively well. There are now projections in the current budget cycle for the next fiscal year that we're going to have an increase, and a significant increase in state revenues. So what about local governments? I just mentioned sales taxes. A big part of local governments, particularly school finance, comes from sales taxes. So what's happening in housing? Well, housing's on fire. California home sales, this is California Association of Realtors numbers, and California home sales are higher than they have been since back in the aftermath of all of the foreclosures that happened in the Great Recession. And those were blowout sales at discounts. These numbers go through October of 2020. But instead of homes being blown out in a bad market, this is a very good market. And that's because of low interest rates and because of that differential between high income earners doing reasonably well going through this recession and low income earners doing very poorly. So here we see the S&P Case-Shiller Home Price Index for Los Angeles, San Diego, and San Francisco compared to 2017. 2017 would be 100%. And home prices have been growing. If we were to do this with median home values, we'd see the same thing. So home prices are up. Most California real estate is assessed at below market values. And so our expectation for property taxes is that for most jurisdictions, we're going to see at least the same as last year, if not higher. And that has implications for construction. This is new residential permits. The green are actuals, again, through October, and the blue is our forecast. That kind of demand that's generating those increasing prices means that builders can make their business plans and can develop new properties. And you're going to see that when the Alan Matkins UCLA Anderson Forecast Commercial Real Estate Survey is released. The builders are optimistic in the multifamily space, and our forecast is for an increase in construction throughout the forecast horizon. That means a demand for additional workers in the construction trades. So that's some of the good news. Now, turning to logistics, which is another place where California is a little bit different from the US and where we might differ in our forecast. A part of that is seaport traffic. What you see here is the year-over-year change in goods movement at California ports, exports plus imports. And so over on the right-hand side is August, September, and October. And compared to August, September, October 2019, the ports are actually processing more goods. And that includes an increase in exports of food products out of the Port of Oakland, where exports now exceed imports. So at least in the logistics industry that's supporting our seaports, we don't see any danger here. And of course, the other part of logistics is in the distribution of goods from online shopping. So logistics is going to hold up and be a growth area. But now turning back to that first slide that we saw with California having more stringent non-pharmaceutical interventions than many other states, we want to ask the question, why is California's unemployment rate so high, and how much of that is due to the interventions, and what does that mean for the future? So what you see here is unemployment rate by states ordered from lowest in Nebraska over on the left, the highest in Hawaii, and on the right, and California is in gold here. And the US average is this dashed line. So California is above the US average, but California has more stringent NPIs. And what we did was we ordered the states, or assigned to the states, one of three designations. One was average NPIs, average intervention. One was more stringent, where you found California, and one was less stringent, where you found Nebraska, for example, or South Dakota. And then did some statistical analysis to try and estimate what portion of this unemployment rate above the US average in California was due to its more stringent NPIs. And so that I'm going to show you in the next graph. This is taking out the impact of NPIs according to our estimates. California is again in the gold. It's above the US average, but it's kind of moved to the left and close and shrunk towards the US average. Still historically high relative to the US. The two red there are Florida, that had very mild interventions, and New York, that's very similar to California. But those are the three states, if you remember, that I suggested were the states that hosted the most foreign tourists. And we certainly see that impacted California. Now, Leo talked about some of the problems with the unemployment rate. So maybe this is not the best measure. Another measure would be the growth in jobs, the growth in non-farm employment. So we did the same exercise with that, and the chart that I'm going to show you next is the same as this, except for instead of unemployment, it's the results that we got for non-farm employment growth or decline. And so here that is, and you can see in every state we get a decline. The dashed line is the average decline in the US. And after taking out the impact of California's non-pharmaceutical interventions, California is actually doing better than the average for the US. So all of this suggests that it's really all about the pandemic. But the question is there long-term damage that's being inflicted on the California economy because of the more stringent NPIs? And when we entered the pandemic, there wasn't a lot of evidence from the last great pandemic in the US, the 1918, 1919 influenza pandemic. But since then, economists have done a number of studies of that pandemic and generated really interesting data, and they all show about the same thing. So I want to show you one part of one of them. This is in a paper called Pandemics Depress the Economy, Public Health Interventions Do Not, Evidence from the 1918 Flu, and it's by Correa of the Federal Reserve Board, Luck of the New York Federal Reserve Bank, and Vernier of MIT. And and this paper is available on the web, so it's an interesting paper and well worth the read. What you have here are a bunch of dots, and each dot represents a city. The green dots represent cities where NPIs were greater than the median, and the red less than the median. Across the horizontal axis is mortality rates, and the vertical axis is change in employment from 1914 to 1919. They used a number of different measures of economic activity and economic growth, but this is very much illustrative of this. You see that the greens had lower mortality, so they had better health outcomes, but they also had better economic outcomes. And kind of all of the analysis that has been done on this 1918, 1919 pandemic suggests that at worst, the economic outcomes are identical, but there is some evidence that the economic outcomes are really better when you have the interventions such as that which California has had. Now, a caveat, 1918 was an influenza pandemic. This is a COVID-19 pandemic. It was a different economy at that time. So it's not directly translatable to today, but it is very much suggestive that, at least there's no evidence that the NPI policies in California will have long-term damage to the economy. So that leads us to the summary. It's still all about the pandemic. Contemporaneous restrictions obviously lead to worse immediate economic outcomes, and this is being felt certainly by small businesses throughout the state. But there's some evidence that better health outcomes lead to better economic outcomes as we move forward. Our job loss in the state is concentrated in these human touch sectors, partially due to public health restrictions, but also partially due to risk aversion by consumers. And tech, logistics, and housing all show strength and will lead us out of this recession. And government is in the unusual position of not seeing a dramatic implosion of revenues. And a caveat to that, for those localities that are heavily dependent on tourism, they are, because transit-oriented taxes, parking and the like are simply not coming in. And so they're seeing a significant reduction in revenues. And, in the city of Los Angeles, you see that in the latest budget projections that it's heavily concentrated in a collapse in revenues for transit-oriented taxes. So that brings us to our forecast of unemployment rate of -8.3, declining employment growth of -8.3%. And then it goes up to 6.1% and declines to 2.2% in the out year as the unemployment rate comes down from 10.3% to 4.4% in 2023. So as soon as we get past the pandemic, California starts growing, and growing actually faster than the US as it catches up. In terms of housing, going from 106,000 units this year to 132,000 in 2023, a fairly significant increase, but still not enough to move the needle on housing affordability. And let me leave you with this image up in the San Gabriel Mountains. We're not out of the woods yet, And we have a winter to go through. As Leo suggested, it may be a very harsh winter, but underneath this snow, when it melts, we'll see a pathway that's headed up towards economic recovery.